We're going to talk about the history of the fund, where the funding and contributions, where the money comes from that's in your pension plan, what a normal retirement is, touch on the drop and the COLA and the share plan, some of your death and disability benefits, and the optional forms of payment. Katie kind of hit that optional forms of payment. We let her go first. There were some guys that were, she wasn't able to make the first one. So there are people that wanted to come from the first session to get to see her and ask her questions. So our fund was started in '45 by a special act of the legislature. We're a special act plan. At that time, the mandatory retirement age was 60 and the benefit was $125 a month. Over the years, you can see we've made a lot of improvements to our plan. We enacted the 20-year retirement at 60% on the average final compensation. In '88, we upped it for the COLA. 2000, the drop was added. The employer pickup was authorized. What that means is now your contributions now became pre-tax money as opposed to after-tax money. In 2008, we made some changes to comply with Chapter 175. Remember, we had that 175 money that was just sitting there and it wasn't being used. We had to meet some minimum requirements. Even though overall our pension was better than what the state said it needed to be, there was a couple small details, some of the 10-year certain type things that we had to tighten up, and we used some of the money for that. And then our last change in 2009, 2010 was the 3.4% multiplier. We added a 5-year drop, changed it from a 3-year drop to a 5-year drop, and that share plan kicked in. That once we met the state minimum benefits, all the money after $2.1 million will kick into your share plan. I'll get into that a little bit more. Right now, the board is myself and Ron Glass, who I wanted to steal the Chief's thunder, but we were just reelected. The email hasn't been out yet. Chief Raybon is still our 5th member. The pension board's made up from 2 members elected from you, 2 that are appointed from the city, and then the 5th is selected from the 4 of us. Right now, Chief Raybon sits in that seat. Now that he's gone, we'll fill that seat with somebody else. We wanted to leave him until the elections in case there was a change in the board, and the new board would have a chance to select that 5th member in case Ron or I weren't on the board again. The funding and contributions, you pay 7.49% of your payroll into it, and then any shortfalls of the premium tax for the 175 money. So the last couple years, we've actually paid a little bit higher. You've gotten a letter that said, hey, we didn't meet the money for the 175 program. In 1999, City of Miami sued the state and said, hey, this 175 money is supposed to be improve our pensions. The cities were just using it to help offset some of their costs. So in '99, the state said, yeah, you're right. But what we'll do is we'll set a floor. So the money that the cities get right now is theirs. Anything over you get from the 99 value on will be used to improve your pension. So for the city of Orlando, our floor is $1 million. So the first $1 million of 175 money we get goes to the city. When we made those last plans, when we added the share plan, the 3.4% multiplier to pay for those benefits, we took the second $1 million of 175 money and annually pay to cover the cost of those benefits. What happens if we don't hit that 2 million mark? It's really close to about 2.1 million. We don't get that money in from the state. We're responsible for picking up the rest of it to get us to that threshold. And that's happened the last 2 years. You'll see this year coming, I believe you'll actually get a small deposit into your share plan like we were getting a few years ago. So you'll end up, it's going to be minimal, probably less than $100. But now because property tax revenues have gone up, property insurance revenues have gone up, and now so that money that we're getting from the state is going up. The return on investments, that's our largest factor. That's really what drives your pension. We have, I think we have 298 million. I think the next slide has it, or 315 million is what's in our plan. The interest off of that is what drives the value of your pension. That's what supplements it. And then the city contribution. The city's on the hook for the rest of it. The actuary does this calculation every year and says to fund these benefits, this is how much money we have in there, we need to have in there. So they look at how much we put in there, what the return on investments are, and then the city's on the hook for the rest of it. This is the returns that we've had. We assume an 8% return. Last year we had a very, very good year at 14.2. The 3-year average is 9.4, 12.6, and 7.7 over the last 18 years. So we're just shy of hitting, you know, our benchmark of 8%. This is the funding ratio. You talk about how healthy a plan is over the years. This is our funding ratio. We are at a high here at, in 2007 at 95. You can see the market, the real estate or the stock market crashed. Our funding value went down, and now it's starting to climb back up. So when you hear about the pensions are unfunded, they're talking about this number, about it. And it's kind of like a pension is similar to a mortgage in that most of us don't have money cash sitting to pay off your mortgage. And that's what this says. If the pension, if we were to freeze everything, right now you'd get about 84 cents on the dollar on what the pension owes you. If it was to stop today, it'd be like, hey, if the man came and said you gotta pay off your mortgage right now. That's what it would be like. So, but this is over 30 years. We know the money's coming in, so the health of the pension is fine. It's just the way that they look at it actuarially. These are the city contributions. Oh, on that last slide, back in the in 1998 to 2002, we were over 100% funded. So if the stock market just kind of does its normal thing, we're very good. These are the city contributions, and you can see in 99, 2000, they had very little contributions. They had under $1 million. You know, in 2001, they had under $1 million. And that has ballooned up to over 14. The percentages here, this is how the percent of payroll that the city's kicking in. So they kick in a lot of money for our pensions. They've been on the hook, and they've been a very good partner with us. You can see we just, only a couple years ago we had benefit improvements where a lot of places are having benefit cuts.
You're hearing a lot about cities that are funding the pension more in tight financial times. If something turns around even worse, what does that do to our pension? I mean, obviously, that's a huge chunk of change we're not getting in. How would that affect the...
If we don't get that money in, then certainly the funding ratio is going to go down.
And it's going to be actually in the fund, but like, is there a point where you pass on to us where you go, I know we're paying you $6,000 a month, we're going to turn that into $5,000 a month until we turn this around. How does that happen, or is there a plan in place?
The way that it changes to our pension fund work, like I said, we're a special act of the legislature. So what that means is we have to go to Tallahassee to make any changes to our fund. So the city council just can't have a meeting tomorrow and say, hey, we're changing the plan. It has to be negotiated between the city, the pension board, and the union. The three of us have to walk up hand in hand to Tallahassee, get the legislature to make the change in more or less state law, and then that change will be enacted. So for one party, whether it's the pension board or the union wants to just skyrocket the benefits, or the city wanted to lower them, it's a tedious process, and it helps keep those kind of things. It really helps stabilize our fund, and so we don't have wild swings either way.
Can the city just say we're not going to contribute as much though, without going to Tallahassee?
They could, if they hit dire times, they could choose not to make the full contribution, and that's what's happened. Chicago, some of the stuff in New Jersey, that the cities and the state haven't made their full contribution, and that's what's hurt some of the pension funds and why they're struggling some. The city's never done that. They've always made their full plan, and they've done it. Right, and what it is because of the crash, it really boosted the city's contribution up, and as we continue to get that return on investment. We got 14% on $315 million, which is a healthy chunk of money. And that eats into what the city's having to pay. You know, some of this too is also payroll growth in that we've added members of the department. So you kind of have to take that into effect also. The drop, it allows you to continue to work without increasing your average monthly salary or years of credit. It'll freeze your pension benefit. You can enter the drop after 20 years of service. We've talked about, we have the 6-month, 60-month, 5-year forward or back drop. And if you hit 30, you lose the ability to go to the drop. So really, if you're going to back drop and you're going to be a 30-year employee, you're truly going out at 29 years and 11 months. You have to be out before that 30th year, otherwise you don't have that back drop option anymore. And then some of the forms that Katie handed out, they like to have those 60 days prior to your retirement. So they can begin your calculations and begin the process of you separating. This is a comparison of the forward and back drop, because you guys want to know what's best for me. And this is what, sure, come on. Kind of let you know is the pros and the cons, and then you can decide what's best for you. So they're both 5 years in length. So if you have a 25-year employee, he back drops 5 years, or a 25-year employee that entered the forward drop at year 20, your numbers are the same. Okay, because you'll be based on a 20-year pension, and then you'll have 5 years of drop money. The interest accrued that we talked about is the same. If you enter the forward drop, you're no longer making pension contributions at 7.49%. For a lieutenant, that can add up to about $35,000 over 5 years. So it's not an insignificant number or something to think about. If you choose the back drop, you're just paying the contribution the whole time. If you enter the forward drop, you're no longer eligible for a disability pension. That's off. You've given up that option. Your pension is set at whatever it was when you retire, whether it's at 20 years, 22, 25 years. If you choose the back drop, and I think it's the biggest factor why guys choose the back drop now, especially now that we have the 5-year back drop, is that you're still eligible for a disability pension if you were to get hurt on the job. Once you've entered the forward drop, there's no takebacks. You've committed to going down that path. You will separate service in sometime in the next 5 years. And like Katie said, it's not, you don't have to stay 5 years if you enter the forward drop. That's just the max amount of time that you can stay. And with the backdrop, since you haven't declared anything, you can still change your mind. If you have some type of life-changing event, marriage, a new kid, spouse loses a job, something like that, where your circumstances have changed. You said, I'm going to backdrop at 25, and something changes. Well, you still have the ability to stay here and stay working. Whereas if you were in the forward drop, you would have to leave when that 5-year mark hits.
You don't elect backdrop until you actually sit down and meet them.
Right. There's no election, or you haven't decided to do anything.
So where's workman's comp come in if you're forward drop?
Work comp is a completely separate animal. You do not give up any work comp claims, insurance. That work comp segment continues to work the same whether or not you're in the forward drop or the back drop. You don't lose any ability to pursue a work comp claim by going into the forward drop. The COLA, after 20 years, if you retire after 20 years, you're eligible for COLA. It's 5% every 3 years. If you're in the forward drop, your drop month, you don't receive a COLA there. And if you, I'll just do this a second. If you leave before 20 years, you're not eligible for a COLA. And the COLA is the biggest chunk of your pension. Of that 7.49%, paying for the COLA is the biggest chunk of that. You don't get that money back if you don't stay long enough to be eligible for a COLA. Also, if you go out on a disability, whether it's line of duty or non-line of duty, you don't get, you're not eligible for a COLA. So some of the young guys that we have that go out, they don't receive a COLA.
Is COLA for life?
COLA is for life. It used to be, you had to, I think you had to be age 52, and then it maxed out at 65 is what the old plan used to be, and that's gone. So it's every 3 years.
What about for your beneficiaries as well?
Yes.
Doug, go back over number 3 again there, your third point.
The drop fund does not receive a COLA. So once Katie's calculated what your benefit is, in the example that we're using, it's around $6,600. That in your drop fund, your first COLA doesn't kick in until 3 years after you've separated service. Not because you've retired, because as far as the pension looks. So as that money, you'll get a statement on how your drop fund is accruing. You won't see that 5% bump after 3 years. It's when you don't get a COLA until you separate service, to actually leave, not until you enter the forward drop.
So you leave at 29 years and 11 months, you get it 3 years after.
3 years later.
3 years after you get 5%.
Now, now, when you say that, you mean if you go into the forward drop, correct? The COLA, from what you're saying, doesn't start until you actually separate, not from the time you sign.
Right, not from the time. So you won't get a COLA, your pension won't get a COLA if you enter the forward drop. If you did 5 years, it won't get it
Yeah.
in the middle there at that 3 year mark while you're still here.
The other question, why wasn't it like a across the board decision as far as like, if we go into the drop for that 10-year certain, it starts from the day we sign the paperwork. So if we're in the drop for 5 years, that's 5 years gone from that 10-year certain. What I'm saying is it starts on one thing when you sign the paperwork, but it doesn't start.
Right. I can't tell you. I don't know why they're different. I don't know why they
They would have costed more money.
yeah, I don't know why they treat it different. I'm not sure.
No. Like
What he's saying is when you go, if you enter the forward drop, you start whatever that number is. And this is our example, it's around $6,600. The clock starts ticking on somebody is getting that check for that amount for 10 years. And then depending on your situation, if you were to pass away, your spouse gets that for 10 years from the time you enter the forward drop. And then after 10 years, it drops down. But he's saying in that, why is that treated different? Why is the COLA treated different? The clock doesn't start for your COLA until you separate service. I don't know why they're different. They are.
If you die while you're in the drop, then that $6,600 is going to your spouse, and the drop account money is going there too, or you gotta allocate that?
The drop account money will go to the designated beneficiary.
Okay.
Also, that 10-year certain will go to the designated beneficiary. You do not have to have, why you would do it, I don't know. The beneficiary of your 10-year certain does not have to be your spouse. So you could separate from service. 2 years after you leave the job, you pass away, you've designated maybe a child as the beneficiary of your 10-year certain. The money would go to them. Once 8 years after that, 8 years after your death, 10 years from the time that you retire, the 75% would then go to your spouse.
But if you die while you're in the drop, is what I'm saying. It works the same exact way.
Same way.
Just like you were retired.
Yes.
Or gone. Separate.
The backdrop was paid for that with 7.49%.
Right.
Yeah, so the drop money was
Thank you.
Yeah.
Correct.
They wouldn't get a full 5 years.
Yeah, it
drop.
doesn't continue.
Right. We'll hit the share plan real quick. We had it in 2009. Like I said before, it's funded from the 175 money, and it's above the 99-1, the 2009 benefit increase. It's divided equally among the people that are here that year, so I think our strength right now is about 530, 535. So whatever money is in excess from last year will get divided equally amongst the people that are here. It doesn't. Your rank, how long you've been here, new hire gets the same cut of it as a 30-year guy. We all have 401A accounts with Nationwide. When we had that money that had kind of been accumulating because we didn't meet the minimum benefits and we couldn't use it, once we met the minimum benefits, we went back and made those distributions that they had occurred over those years starting in '99. And that's why I think the max contribution at that time was about $24,000. And this money is available upon separation for your death if you're still employed.
Isn't there an age limit on that?
We'll let Angela will get into age limits and those type things on it.
Hey Doug?
Yes.
Can you touch on the backdrop about there is no undeclared backdrop? Let everybody know about how that there is no monies for in case of a death.
Right. If you were, a 23-year guy, your mental plan was to backdrop, and you pass away, your pension will be based on if you had just retired that day. There wouldn't be a drop. You're not there to declare that you wanted to backdrop. So your spouse would get whatever benefit it is that they're entitled to. Whether if you died and it's not job related, there would be a 10-year certain period, and then after that they would get 75% of whatever your normal retirement would have been. If it's a line of duty death, obviously it's different. It's 80% tax free and all that kind of stuff. But there is no backdrop if you were to die while you're still employed. The death and disability benefits. The death, there's the line of duty with 10 years, with more than 10 years, and then non-line of duty, the same thing with and without 10 years. And then the disabilities, you get a disability for, you can get line of duty, non-line of duty with less than 10 years, 10 to 20, 20 to 40, and then you begin to accrue benefits again after 40. I don't know why you can be here. This is, this is a breakdown of the disability benefits. Line of duty benefits are tax-free. If you have less than 10 years, you'll get 80% of your average final compensation. There's a 10-year certain and a 75-year benefit. 75%, excuse me, survivor benefit. 10 to 20, you get 80% of your average final compensation, a 10-year certain, 75, so they're basically the same. At that 20-year mark, now your COLAs kick in. So they're treated just like you have to be here for 20 years to have that COLA kick in. But now a 10-year certain kicks in. Then at 20 years, you'll get to that 60%. After every year after 20, you can accrue another 4%. So you get to that 25th year, and that'll be a max of 80. Again, your survivor benefit kicks up to 75%, and you'll get a 10-year certain, and the COLAs kick in. So really, a non-line of duty after 20 years is basically a normal retirement. Is really what you're looking at. On the death benefit, less than 10 years, you get a 75%. If you don't have spouse or children, then it's a refund of your contribution. Your parents or a brother or sister wouldn't get a benefit from us. Line of duty 10 to 20, you have 75% survivor benefit and a 10-year certain. And then after 20 years, that COLA kicks in. On the non-line of duty, if you're less than 10 and you pass away, it's just you get a refund of your contribution. There's really no benefit from the city. If you pass away, it's not job related, less than 10 years on the job. 10 to 20, you'll get the 4% with a 60% max, a 10-year certain, and then depending on your age, you'll get a 65 or a 75% survivor benefit. 20 to 40, it's a 75% survivor benefit, 10-year certain, and a COLA. So really that 20 years when the COLA kicks in. And at any time, if you've had especially on the non-line of duty, if you have more than 23.5 years of service, you'll get the higher percentage. It would be treated as if you just went out on a normal retirement. That'll give your spouse a higher percentage. What we think of as a normal retirement is based on your base pay, your EMT, your longevity, and your educational incentive. That's it. No special teams, no overtime, no work back, none of that kind of stuff goes into it. It's another thing that has helped the health of our plan. It doesn't allow us to spike it like the FRS does or some other local plans where you could really hammer the overtime in your calculating years, and you would end up with a greater benefit than what you really contributed for. You get a retirement, you're eligible for retirement after 10 years, and you'll get it once your starts to become payable at age 47. If you retire with less than 20 years, that 10 to 20 year mark, your multiplier is 2%. And again, you have to be 47 to kick in. So if you get hired young, you leave at 20 because there's some other great opportunity, you won't start collecting a check until you're age 47. At age 20, the multiplier changes from 2 to 3.4, and it's retro. So now at 20 years, you'll get 68%. Whereas at 19 years, you get 38. So it's a big difference. The max is the 85%. That's a 3.4 times 25 years. Then if for some reason you stay past 42.5 years, you can begin to accrue benefits. I think Don Gallette's looking at that option. Your average monthly salary, Katie kind of talked about that, how it's calculated. She looks back at your last 36 months. And whether that is based on whether your drop option or what you do with the drop, that could be your date of separation, or if you back drop, it could be 36 months of salary from 5 years previous. You know, so really, if you do 5 years worth of backdrop, she'll look back 8 years to see what your salary was then, because then she'll calculate your pension benefit based on the 3 years before you backdrop. Does that make sense? People who are promoted within those last 8 years, you kind of got to look to figure out what's best for your option. You know, is backdropping 3 years better for you, and then you're not getting back into, if you're promoted to chief, you're not looking back at lieutenant's pay. So now your entire pension is based off of your chief's pay. So those are some of the things you might want to look at is how a promotion or a raise affected your money. That just automatically thinking, looking back, I want 5 years of drop money, might not be the best option for you. It might be better for you maybe to drop back 3 years and have that higher monthly benefit.
On that average monthly salary, 5 of the best 10 years, can you go back as far as you want?
The 5 of the best 10, yes. If for some reason you were in a situation where 5 years ago your salary was better than what it is now, you know, I'll use Sean Steiner as an example. This probably won't hit him. Promoted to district chief and decided to go back. Highland. Yeah. So there might be a couple quirky situations that looking at that 5 of your best 10 might be your best option. But for the most of us, how most of our careers flow, where you gradually step up a ladder or don't take a step back. The final 3 years is what probably 99% of our guys, their calculations are based off. Katie talked about this, the optional forms of payment. They're all, as far as the actuary is concerned, they're all an equal benefit. They're just tailored to what fits you best. If you're going into the forward drop, you pick what benefit you want then. If you're not going into the forward drop and you're either retiring or backdropping, you select which form of benefit you want then. Once it's selected, the option can't change. But your beneficiary can change depending on your situation, and that has to do, you can change your beneficiary on your 10-year certain, or if you take the,
Minimum benefits, 75% or 100%.
Right.
The minimum benefits that I showed you guys, 100% to 66 2/3 to 75%. You can actually, it doesn't have to be your spouse on that. You can change your beneficiary if something was, if your beneficiary predeceased you, you can change the beneficiary, but you remember what I said was your benefit goes down to that lower benefit, and then they recalculate your benefit based on the new beneficiary. Because it's the reduction is based on age difference and on life expectancy. There's a lot of factors there. So, but you do have the option to change your beneficiary at that, on any of
the joint beneficiary.
joint benefits, right?
When you retire, your retirement's effective the first of the month, and you get your check on the end of the month. So, if you live close to the, you know, if things are tight, be prepared for that when you retire. You'll be without pay for close to a month.
Well, then you get your final check.
Right, you get your, yeah, that's true.
Get your
So
final
you
check,
should be all right.
any of your accruals that you have, that's paid out, and then your sick time is either half or a third of that. The old sick time that you guys have, so you get that final check.
When's that paid?
Depends on the pay cycle, when you separate employment, so they don't cut you a check separate out of pay cycle, so if you're bi-weekly, so it's gonna, whatever the first bi-weekly payroll is after your separation.
Yes, sir.
Right, your sick time, not your personal leave, personal you get 100%. The sick time that you guys had, it's either 20 years is a third, 25 years is a half.
When does, on the sheet you get off the, that area on the website, the total contribution, the total post-tax, we've already paid that, is that one you got back? Or is that, I heard of the separate check, and I heard of the distribution, or what is that?
The post-tax contributions that you guys paid originally, when you first started working for the city, okay? Your monthly benefit that we're calculating, the post-tax is excluded over a 10-year period. So a small portion of your monthly benefit that you receive is going to be non-taxable. The remainder, the majority of it, of course, is going to be taxable. But because of you guys paying post-tax contributions way back when, now if you backdrop, what happens is, because the actuaries, I have an actual form that I keep the actual post-tax, and then takes into consideration your age and also your beneficiary's age. So if you backdrop, what we have to determine is, from that point to now, you've been earning these monthly benefits. How much of each one of those monthly benefits was non-taxable? So when I cut that check for the backdrop, you are going to get that post-tax portion. Maybe $500 and maybe $1,000. It could be $3,000. It all depends on the factors. Or same as if you forward drop when you separate employment, because your monthly benefits have been going into this drop fund, then that small portion of your monthly check, that's going to be paid directly to you. And then the remainder of it, which is your pre-tax dollars, that's going to, you're going to roll those over. You're going to give us, instructions on what you want to do with that money. You're going to decide what you want to do with that money.
When taxes are taken out of our pension check, besides income, do they still take Social Security out or anything like that?
Just your federal withholding, Social Security no longer comes out.
It's a retirement check, so you're no longer contributing from your retirement check to your Social Security.
Do we pay less in taxes on that income because we're retired now, or is that?
You'll have less withdrawals from your check. Your tax bracket or whatever you're withholding would be the same, but there's no pension stuff, there's no whatever other insurances you have or whatever. If you have a policy with Luton or something, those union dues.
Does the city still pay for the other half of that income tax, like they do right now?
They don't pay half of the income tax. That's Social Security. Social Security is what they pick up. That is split between the employee and the employer.
I got a little different question. On the sick leave percentage difference from 50, I understand that at 25 years. at 25 years you backdrop, is it at separation or is it at?
That's separation.
It's at separation, so if you did 25,
It's at your current rate.
you're gonna get that. Okay.
All right, so I'll walk you through what a normal, what we think of when we retire, what our normal retirement is. You get the 120 months guaranteed payment. Someone is getting your calculated amount for 120 months. Again, how the multipliers work, we just looked at that. It's 10 to 20. It's a 2% multiplier payable at age 47. If you retire after 20, which I think we all think of, it's at 3.4. You max out at 85%. We've talked about that if you pass away before that 120, the designated beneficiary gets 120 payments. At that point, if you're married, your spouse would then get the 75%. Minor children, like Katie touched on before, will get 25% of the spouse's 75% until they turn 18. So they'd be entitled to that benefit. So if you were divorced and remarried, or you had kids from previous relationship or something, they would get that. And then if your surviving spouse remarries, it doesn't change what the benefit they get.
Another thing is if you're not married at the time of death, or if you separated during your retirement from your spouse and you do have children under the age of 18, then they get the full 75% split between however many children you have. And then as they turn 18, their portion goes away. It doesn't go back to the other children. Their portion goes away.
The joint pensioner. You can name anyone as a joint pensioner. That first option, the spousal benefit only goes to your spouse. It was the spouse that you were married to when you retired, and the same spouse you retired to when you pass away. Under a joint pensioner, you can name anyone as the beneficiary of your pension. Obviously, if you name someone that you have a minor child and you name them, it will reduce what you get paid on a monthly basis because of the life expectancy of that child. They're expected to live another 50, 60, 70 years. So it's modified. Your payouts are modified based on your age and the age of the designated beneficiary. When you do that, if you choose this route, you can change your beneficiary. And then your pension benefit will be recalculated. So if you are in a long-term relationship and you had designated that person as the beneficiary, they passed away, or you're no longer in that relationship, and you wanted to change who your beneficiary was, you can do that. And then based on what their age is, they'll recalculate what your benefit is. There's 4 different options that you can choose with the joint pensioner. You both get the same benefit on first death. Upon first death, the second one is it will drop down to 75%, 66 2/3, and then 50. And I have one of the charts will show you that. Option 3, Katie touched on, there's a life-only option. There's no 10-year benefit. It's only payable to the retiree. It gets you your biggest check that you could possibly get, but the second that you pass away, the benefit ends. Unless you happen to you chose this and you passed away very close to separation and you hadn't received the full amount of your contributions, whatever that is, will be returned. But we'll see here in a minute. If you choose this option, you get $50 more a month. That's if that. And then when you pass away, all contributions change. So it's one of the things with those 175 changes that the state had us add in. It's a state requirement, but it truly isn't a benefit. Yeah, I think I have a better version of this up here, so you can actually see it. This is the same sheet that Katie showed you a little while ago. She talked about how they come up. They look at the fiscal years, not the calendar years, of how many hours you've worked. So that 281 that's on there, you have a copy of this. The 281, 921 that is your accrued salary over the previous 3 years. Then she divides that to figure out what your annual average final compensation is. And then in this case, this was a lieutenant that retired at 25.8 years. So their max benefit was 85%. So 85% of their annual salary is $6,600, $6,656.
One thing that you guys want to keep in mind, if you are ever in a no-pay status during the 3-year average, annually I send out a lost time report. If you've lost time due to, say you were out on workers' comp, because you're not paid, you're not contributing to the plan, and if you've lost time, you want to pay that time back, because that's going to affect your average income. Because if you don't pay the time back and the lost time that you have for the year, then that's going to affect your average. So I'm only going back 36 pay periods. So if you've got time that, and your income is within that 3-year period, and you lost time, you lost that income as well. So you want to make sure that anytime you receive the notification from me, that if you've been in a no-pay status, that you respond to that. Or if you do it, if you're in a no-pay status during, say this year, you can, when you come back to work and you start getting a regular check again, email me and let me know, and I can calculate what your lost time was. Because it's actually better for you to do it when you come back than wait for me to do it at the end of the year, at the beginning of the year rather, because whatever you're paying it back at whatever your current salary is. So you've already got an increase, and you're paying it back at a higher rate at that time if you wait until I do my annual reporting. So keep that in mind.
So this is a summary with actual numbers of the different choices that you can make. So this was a lieutenant that retired with 25.8 years. The average annual salary was $93,000, and he was age 54. The spouse, he was married and had a spouse that was age 51. So if he takes the 10 years of life certain, the benefit is $6,600. Upon his passing, the spouse benefit will be $49.92. If the spouse passes away before, if you take the life with 10 years certain, your benefit does not change. All right. These other ones it does, and that's why there's that asterisk. So that's this $4,900 is 75% of your benefit, and that's the normal spousal benefit that you think of. Under the joint beneficiary, and this will factor in if you got married late in life and you chose to backdrop, if you need to be married at that backdrop date. So if you go back and say, I want to backdrop 5 years, you need to be married to that spouse at 5 years. If you weren't married to your current spouse during that time frame, you'd want to start looking at this. And this way you can name that spouse as the joint beneficiary. So your benefit would drop down. In this case, it's to $6,000, $6,100. And now it's on a first death basis, not your death. So if you choose this one, your spouse or whoever that beneficiary passes away, your benefit automatically reduces. All right, and the 100%, you guys each get the same, nothing changes. In effect, it doesn't matter which one of you passes away first, because you're both getting the same benefit. If you want to get a little bit more each month, you can choose a 75% for the surviving spouse, 66 2/3, or 50%. But it's on the death of the first beneficiary. So it's either you or your spouse, not just you. So if your spouse passes away first, your benefit would go down. So if you chose this because you want to try and get your monthly, initially your monthly benefit similar to what it would be under the 10-year life certain, and your spouse, your designated beneficiary, passes away, your check would go down to $3,200. So generally, most of us go with the first option there. There's some certain cases, especially a marriage towards the end of your career, that the 100% joint beneficiary with 100% is a good option for you. And now we've rarely to never have had anyone choose any of the other options. So those are really the two options that you're looking at.
Will the COLAs make that difference?
If you retire with more than 20 years and you're eligible for COLA, they will climb by 5% every 3 years. Again, this spouse was age 51. If you drop the age of that beneficiary to a much younger spouse or a child or something like that, it would reduce these numbers even more. It's all age-based and trying to calculate how long the pension is going to be paying out the benefit. So we'll look real quick. This is the last slide I have. This will give you some backdrop numbers. Again, that same lieutenant, 25 and a half years, they maxed out at 85%. If they don't backdrop, they get $6,600. These are the numbers. This is the lieutenant that retired from us, and these are his numbers. If he had chose to backdrop 1 year, he'd get, the benefit would go down by about $100, and he'd have $81,000 in his drop account. You can see it. As you drop back, your monthly payment is going to drop because now it's based on your salary from 3, 4, 5, 6, 7 years ago. But in return, your drop account grows. So that's why you have to say, and I don't think there was any change in status for this, but if someone who got promoted closer to retirement, this is really when you'd look at this, that do I want to get back into my engineer or my lieutenant calculating years, or is it better for me not to drop as much, as far back, and now it's based on my higher salary? And you'll end up with kind of a mix of a better monthly payment and a decent drop account. If you kind of wanted to ballpark it, what would I look like from these numbers as a 30-year employee? They've maxed out here at the 85%, so if you were to do 30 years and backdrop 5, this would be your monthly benefit. And then ballpark, this would be your drop account. It'll probably be a little bit bigger than that. But that'll kind of give you an idea of what a 30-year employee would be looking at. So you got any more questions that
On that 30-year, if you're forward dropping, it would be the same. There's no, since you're projecting forward, it's only one number, that's what you're saying. If you get closer to that 66.
Right, if you at 25 years, if you were to say I want a forward drop, it would still be that same 66 number because it's based on, it's based on your 3 years previous salary. So whether you actually separate or you enter the forward drop, it would be on your 22nd, 23rd, 24th, those 36 months before you separate. So whether you leave at 25 or enter at 45 or enter the forward drop, that number is going to be the same.
Are you getting into ages or?
We'll hit a little bit more about, talking about what with drop money and 175 money as far as, that's what Angela will hit on all that. So I'm kind of walking you up, Katie and I are walking you up to when you hit the door, and then they're going to walk you out when you're leaving, and what pools of money you can do, what you can do with what the different pools of money that you have. There was a point brought up, and I need to add it to this about life insurance. You can continue to stay with the city. Most of us have 3 or 4 times salary. As far as life insurance, you can stay with the city when you separate to keep that life insurance.
Your life insurance is going to terminate, and you will have the option to port that over on an individual basis. Okay, the rate's not the same as what you pay, it's what you're paying currently with the city because we have a group rate. It is a reduced rate. The advantage of doing that is one, there is an approval process for that, but you meet for the majority of you guys, as long as if you're not going out on disability or something like that, because you would not be eligible to continue it without application. You could continue it under a whole life policy, but not a term policy. The rates it's comparable with you find outside, but you don't have to go through the medical evaluation. So that's one advantage of it. But you would deal directly with the insurance company yourself, Standard Insurance. I'll give you a packet that you can actually decrease. You can't increase it. You can decrease the the coverage that you currently have, the life insurance, but you're gonna pay the premiums directly to the insurance company. The city does provide all of our retirees with a premium $3,000 life insurance policy. So say you've got $75,000 worth, and that's the value of your life insurance, your premium that you're gonna pay on is gonna be on the 72, because they reduce it by that 3,000. You can't have more than what you have as an active employee. So what they'll do is they'll reduce, you're gonna pay on the 72 versus the 75,000. But you will have that option to do it, or you can get it now while it's less expensive. You're at a younger age. Start thinking about that now instead of waiting until you retire to purchase life insurance, because the older you are, the more expensive it is.
So that's something that that was brought up to us, to start thinking about those type of things now, not as close to retirement. Maybe, you start to look at those things 10 years out from retirement. And then we kind of touched on the other thing, talking to retirees, tried to get some feedback from them on things that surprised them, or things that they weren't necessarily aware of. And the other one was the health insurance, and the health insurance for the spouse. That right now, that even though we like to think that we pay a lot for our health insurance, the city's paying 3/4 of it, 73%. So if you have your kids or your spouse on your insurance, that number is going to go up significantly on your retirement.
Now, for those of us who don't have retirement insurance after retirement, we have the insurance plan set aside. We're
Right.
responsible for 100% of the fees that money.
Yes.
I got a question back to Katie on the life insurance. So if I'm at 3 times my salary now, when I separate, I will be at 3 times my pension salary?
You're 3 times your salary, that goes away at term. It's a term policy. So and you'll have 31 days to decide at the time of retirement whether or not you want to port your existing life insurance over to an individual policy, and then you start paying the premiums for that.
What's that cover to wind up? Was the 75 an arbitrary number, or is that? Well, how much life insurance will I have with that?
Whatever, you can port whatever your value is right now. You can port the same existing life insurance, but you're paying the premium instead of the city kicking in, because the city's kicking in on your life insurance, so you're gonna pay the premium. And there's a lot of different factors that's used at that point. So if you want a packet, I can send you a packet to determine how much it would cost you.
So Lou, if your salary was $100,000 and you have 3 times $300,000 with the company, when you go to an individual policy, you can keep the max of $300,000. Right, you can keep as much as $300,000 policy with them, and then they'll figure out what you have to pay on
Or you can decrease it,
or
you can decrease it amounts of $1,000 to make it more affordable to you, down to $10,000.
You're entering a forward drop. Is that just your rule will affect, they have to do it before 25 years to maintain your accrual rate?
Yes. Yeah, he asked about your accrual rates. If you retire, excuse me, you enter the forward drop at your 25th year or later, your accrual rates drop. So if you're going to enter the forward drop, even if you're not planning on doing the full 5, say I want to do 3 years of forward drop, you want to do it before your 25th year. Or understand that your accrual rates are going to go down. So if you're a 27-year guy and say I want to forward drop 3 years, your accrual rates are going to drop. So if your plan is to be a 25-year guy, 5 years forward drop, do it right before your 25th year, and your accrual rates won't drop.
2 questions. One, have you got any feedback on outside insurance vendors for your family? If you're in the city as a retiree, you can stick with that probably, but.
Yeah, I don't have any feedback on what the market looks like as far as, it sounds like that if you have a family plan with the city upon retirement, it's $1,600 out of pocket. For your spouse, it's $600 out of pocket. How that looks in the market, I don't know. I don't know what the insurance market is. So it's comparable.
And secondly, playing with the numbers here, you're involved with this stuff. Is there any real large benefit in going tax 25 when you factor the future future value of that drop money and all, I mean, what are you really putting to work for? Besides a larger month, a little bit of a larger monthly benefit, when you actually average out the hours you put into that,
Right.
aren't you working for peanuts?
It could be looked at that. It could be looked at that way. But if you work for 30, now you have that same pension, you work, you know, and that's why everybody's case is separate. If they have another job or another career or something and they don't, you know, if you work until 30 years, it would be 5 more years of salary plus that drop. So, but yes, the difference between 85% as a retiree or 100% as an active member is not different. You're basically working to build your drop account.
But you got the drop at 25, if you back it, it's a lot of $355,000.
Right, but now you're looking at your active salary versus
Especially if you're still on a unit.
that 5-year salary. So it gets into, you know, does everyone understand what kind of Moose is talking about? Yeah. Okay.
Depends on how much you're bringing home in your paycheck.
Right, and that's why everybody's, you know,
You take Social Security out of it,
yeah.
the pension.
Yeah, you know, your 85% is really close to 100% of your salary. You know, you're not paying pension, you're not paying union dues. You know, if you don't keep up some of the other secondary things coming out of your check.
At retirement, does our PFIA change at all, or can we continue that coverage? Since Bob's here, he can probably answer that.
When you retire, you can do one of two things. You can have it come directly out of a checking or savings account once a month, or you can be billed quarterly. Whatever you have when you retire goes with you.
So direct pay to you guys are.
So instead of it coming out of your union dues now, or however it is now, it would be it'd be a direct draw once a month from checking or savings, or you'd be billed quarterly.
And is that a good option upon retirement for your personal insurance, or do you have to go through another medical exam?
No, no more medical. Whatever you have, it just moves.
So you should have that set up before your retirement date.
Yeah, about a month before you retire, you're gonna wanna get either the form to have the automatic withdrawal, or just let them know that it's gonna be switching to a quarterly bill instead of the group billing, which is how the union pays.
Well, thank you.
Yeah, it's a percentage check. Right now it's around $39 a check. That's what you're paying.
So are you guys gonna have this on the portal then?
Yeah, you know, obviously Angelo's taping today, and then it'll be put up, this will be put up on the portal as well.
Can you add your spouse 10 years after you retire to your insurance, if they had a job that gave them insurance, your health insurance?
If there's a qualified lifestyle change after you separate employment, you choose not to, you know, you're not covering them at that time, then yes, you can add, during the qualified lifestyle change, you can add them to your plan, okay? Then you start paying the 100% premium for the spouse at that time. And also, your beneficiaries upon your death, if you're covering your spouse at the time of your death, they do have the option to continue the life insurance as well. They pay 100%, but they do have the option to continue the life insurance. I'm sorry, the medical.
Just one more question.
Jeez.
Once you start collecting Medicare or Medicare, the city becomes your secondary insurance. How much is that a month?
Well,
It goes away.
the Medicare you pay out of Social Security, and it's like right at $100, so we become your secondary insurance provider at that time. So there is a $33.68 that you're paying as an active, as a retiree for you yourself, then that goes away. You no longer have to pay the 5% that the city's charging you for yours. Now, same as if you're covering your spouse and she or he turns 65, then the premium is reduced at that time. It will become the secondary insurance provider.
And what age?
65, or if you're eligible for it due to a disability earlier than that, then you have to file within 2 weeks. For Medicare and